You know, a lot of money has been flowing into treasuries. The yield now on a 10-year to about 2.91%. Remember when it had gotten comfortably over 3%? Now, there's always this question, at what point do people then keep pursuing that and the guarantees and government protections that come with that and eschew stocks? Well, it's not happening, obviously, today with the Dow racing up about 160 points, but it's been whipsawed here. Let's get the read from the investing managing editor over at Barron's, her read on all of this, Beverly Goodman. Beverly, good to have you back. What do we have to look for here with this move?
In terms of rates and what to do with your cash, rates are going to continue to rise. You know, they just went up a quarter point a week ago. The Fed signaled 2 more hikes this year, and that means that cash rates are going to keep going up. What's more is bond issuance is going up. This is the second quarter we've increased issuance. Last quarter was the first time since 2009. So we are issuing way more bonds at much higher rates than they've been.
Now, you're talking about government bonds.
Yes, treasuries.
Because corporations are also upping the ante as well.
Yep.
So what's to stop an investor from saying, especially if you're going for highly rated bonds from highly rated companies, where you can get comfortably more than 3%, to say, hey, I'm going to go that route.
Yeah. Well, corporate bonds still do involve some sort of risk. And
right.
I think a lot of the rush to issuance is they know rates are going higher, so they want to issue as much debt as they can while rates are still fairly low, and it's cheaper for them.
Yeah. But are they in the numbers right now that would have them getting out of stocks, in other words?
Not yet. Cash there's more money going into cash than before. Investors and institutions are moving in that direction. But we're still talking about very low rates. If you're looking for straight income, you can get higher rates on bonds than you can in just like the dividends from an S&P index fund.
Right.
But if you're
that's always the Faustian choice.
Exactly.
At what level do you make that move?
Right. And what kind of risk are you willing to take in stocks? Of course, you can lose capital even as you're sort of drawing that income. But if income's your main focus, you're probably better off in an income-specific fund, either equity income or fixed income.
You know, a lot of people like that income, reliable income, no matter the environment. Let me get your read on inflation. You mentioned the Federal Reserve telegraphing probably 2 more hikes this year. We've had 2 already. What could change that picture? In other words, if tariffs kick in, which are inflationary in of themselves, do you worry about, if you're at the Fed, that slowing down economic activity or the higher prices that come as a result of the tariffs, and you got to quash that?
The Fed has, for a long time, not focused too much on managing inflation, and I don't see that changing in the very near future. I also think that the effects of a trade war and tariffs are not really clear yet, and inflation is almost certainly coming. It's definitely on the horizon. We've actually seen it tick up a little bit, but for investors to really change their behavior in anticipation of it, and for the Fed to really start changing their behavior in anticipation of it, I think we're still a few months away.
So you don't think the Fed is behind the curve right now?
It's hard to say. We're in strange times.
We are in strange times. Beverly Goodman, Barron's Investing Managing Editor.